Hi students, this is the replacement lecture for week 1, lecture 2. Supposed to be on Wednesday 8 o'clock in the morning. So this course is ACN3101. Also, this lecture also applies to ACT3110, and also same lecture is applied to ACT2111. So there are 3 courses, but these 3 courses using the same lecture, same assignment, same exam, same quiz, etc. So even though the code here is ACN3101, it is also for students of ACT3110 and ACT2111. This is topic 1. The title of this topic is Accounting in Business. This is like introducing accounting to you students. Okay, let's see. The content of this topic, first you will see the definition of accounting, and then the rules of accounting and uses of accounting information, and then you will see the difference between accounting and financial accounting and management accounting, and the last subtopic is types and forms of business ownership. Okay, let's see what is accounting first. Very important, because in this course you will learn about accounting. So first thing to do is to know what is accounting. So see here, accounting can be defined as an information system that provides reports to stakeholders about the economic activities and condition of a business. So first thing that you have to know is accounting is an information system. Information system means it has input, process, and output. That is a system. System is something that has input, process, and output. Information system means this accounting is related to information, particularly financial information, dollar and cents, like how many dollar of sales, how many dollar of purchase, how many dollar of expenses, etc. And the system provides report to stakeholders about the economic activities and condition of a business. Accounting system provides reports. It means that the output of accounting is reports. And these reports is useful to stakeholders. It contains information about economic activities and condition of a business. Okay, the second point there, the process of identifying, measuring, recording, and communicating economic information to permit informed judgment and decisions by users of the information. So, accounting, and the simple way to explain about accounting is like this. Accounting is a process to analyze and record financial data and to report financial information. So see here, it is a process, and then the process is analyzing and recording of financial data, and after that report the financial information. So for financial accounting is like this. Financial accounting is a branch of accounting that can be used to record business transaction and to report whether the business is making profit or loss. That is the very simple definition of accounting, financial accounting. Financial accounting is something like this. You have a business. You can use financial accounting to analyze the business transaction, and then to record the business transaction, and at the end of the year or at the end of the month, you can use accounting to prepare report that shows whether the business is making profit or loss, and also the report also can show whether the business is in a good condition or not in a good condition. Okay, so that is accounting. Rules of accounting. Okay, the function of accounting. There are 4 rules of accounting. The first rule of accounting is it is a language of business. Accounting is a language of business because if you are a businessman and then you want to talk about your business, you have to use accounting. You have to use accounting terms. Like when you want to talk about your business, you will talk about profit, loss, revenue, cost, expenses, assets, liabilities, equity. These are all accounting terms. So accounting is a language of business. If you do not know accounting, you cannot talk about business. Difficult for you to talk about business, because when you the language of business is accounting. You want to talk about business, you have to know or to use accounting. The second rule of accounting is it is a decision making tool. When the situation is like this, if you have a business, you have to make many business decisions. For example, you have to make a pricing decision. You have a business, you want to set price for your product. To set price for your product, you have to use accounting. To set price for a product, at least you have to know what is the cost of the product. So let's say the cost of the product is $2. Then you know, if you want to set price for the product, you have to set it at $3, for example. The cost of the product is $2. You have to sell it at $3 at least, or maybe $4, because when you set price, you have to set the price higher than the cost so that you can make profit. That is one example how accounting can be used to make decision. Accounting is a tool, is a decision making tool. Another example is, let's say you have a business and then at one time you think that you want to hire a new worker, or you have another choice is to purchase a new machine. Then how to make decision whether to hire a worker or to purchase new machine for your production. So you can accounting data can be used as a decision making tool. You can compare how much is the cost of a worker and how much is the cost of a machine, and then you compare with how much revenue a worker can generate, compare with how much revenue a machine can generate, and then you can see which one is better for your business, to hire a new worker or to purchase a new machine. So it shows that accounting is a decision making tool. Accounting can be used to help manager or to help owner of a business to make business decision. Number 3, the role of accounting is accounting can create accountability and control. The situation is like this. Let's say you have an owner of a business, and then the business is a big business, so you hire a manager to manage the business. So you, as the owner of the business, can use accounting to to make sure that the manager is accountable, and also you can use accounting to control the activity of the manager. The thing that you can do is like this. You can make this is my simple example. You can do something like this. You, the owner of the business, say to the manager, the manager has to make at least 10% profit every month. The 10% profit is accounting number. Is an accounting number. So when you do something like that, what will happen to the manager? The manager will work hard every day, because you have asked him or her to achieve at least 10% profit every month, or you can make it 20% or whatever number that suits your business. So it shows that you can use accounting to make sure the manager is accountable, and also to control the activity of the manager. He will work hard for you, and you can say something like this. You can set something like this. If the profit is more than 10%, you will give the manager bonus, or he will work hard. And also you can do something like this. If the business is making loss, then there will be no salary increment for the manager. Then he will work hard. It shows that accounting can be used to create accountability and to control people. Number 4, the role of accounting is an information system. Like I said earlier, accounting is a system because it has input, process, and output, and at the same time it is an information system because everything in accounting is financial information. The input is financial data, you process the financial data, and the output is the financial information. So accounting is an information system. Okay, user of accounting information. The focus of this topic 1, topic 2, 3, 4, and 7 of this course is on the financial accounting. Like I said earlier, I just want to refresh your memory. Financial accounting is a method or a system that you can use to record financial transaction, to record business transaction, like a business is making sale, a business purchase something, that is a transaction. A business pay salaries, pay rental, pay electricity. These are examples of business transaction. So financial accounting is a system or method that can be used to record the business transaction, and then also to calculate profit and loss for the business. So it is something like that. So if you have a business, you can use accounting to record all the business transaction, and at the end of the month or at the end of the year, you can use accounting to calculate profit or loss for your business, and also to calculate to calculate the asset, liability, and equity of the business. So financial accounting, it has the final output of financial accounting is called financial statement. Financial statement contains 5 components, 5 documents. The first one is called balance sheet. The first one is called income statement. The second one is called balance sheet. The third one is called statement of equity. The fourth one is statement of cash flow. And the fifth component of a financial statement is called notes to the account. If you have time, you can go to website of a business, of a big business like AirAsia or Alibaba or Maxis or Petronas or Shell, anything. You go there and you can click somewhere in the website a section about investor relation. and you can see or you can download a financial statement of the business. A financial statement of the business is the output of financial accounting. So financial statement, companies, they are compulsory to show and to publish the financial statement to the public. But if you have a small business like a small grocery shop, it is not compulsory for you to publish your financial statement. For companies, it is compulsory for them to publish or to show their financial statement to the public. So now, who are the user of this financial statement? There are two groups of users. We call them users of accounting information or users of financial statement. The first group is called internal user. Internal user is the people or parties inside a business. So, internal user most of the time is the manager of the business. Manager of a business use financial statement of the business to make business decision. Okay, let's say you are a manager of a business. You are a production manager of a business. Every day you have to make many business decisions. How many product to produce, how many workers to hire, maybe how many material to use and how many material to purchase. So you as a manager can use financial statement data or information to help you to make this business decision. So the thing that I want to say is there are two groups of financial statement user or users of financial statement. The first group is internal user. Internal user is manager, and manager use the financial statement to make business decision. The second group of user of financial statement is called external users. External users are people or parties who will use financial statement of a business, but these people are parties outside the business. So the thing is like this. Let's say we take AirAsia. AirAsia is a business. It's a company. Every year, AirAsia is required by law and regulation to prepare and publish their financial statement every year. So who will use the AirAsia financial statement? There are two groups of users, internal users and external users. Internal users are management. Like I said earlier, management of AirAsia, they will use the financial statement to make business decision. The external users are people outside AirAsia. They also use financial statement of AirAsia for different purpose. Okay, see here. See in this slide, external users. The first example of external user is customer. Customer is an external user. Customer, the way customer uses financial statement is like this. Most of the time, if it happen, if the customer want to purchase an expensive item that comes with a warranty. Let's say somebody want to purchase a machine. The cost of the machine is $200,000, and the machine comes with 5 years warranty. So if for that kind of customer, he or she has to use financial statement. The reason is, when the person want to purchase an expensive item that comes with 5 years warranty, he or she has to make sure that the seller of that machine is a business that will exist at least in the next up to the next 5 years. Before the person purchase the machine, he or she has to look at the financial statement of the business that sells the machine and check whether the business is a good business and can exist at least in the can still exist in the next 5 years. If the person see that the company that sell the machine is having a big problem and maybe bankrupt in the next year, he or she should not purchase the machine, because when the company that sell the machine bankrupt, nobody can honor the warranty. So customer use financial statement to make purchase decision. Customer use financial statement to make purchase decision, to decide whether to purchase an item or not. Okay, and then how about creditors? Creditors, see here in this slide, creditors is another example of external user. So we use the AAsia example again. AAsia publish financial statement, and at one time AAsia want to purchase something in credit from company A. So company A is the creditor. So company A, a creditor, should use financial statement to make the credit decision. Company A has to check AAsia financial statement and see and decide whether to give credit to AAsia or not. Basically, the company A, the supplier A, will have to check whether AAsia has sufficient cash to pay the credit term. So creditors, they use financial statement to make credit decision about whether to give credit to somebody or not. Okay, the example, the third example is government. Government also is an external user of financial statement. Basically, the idea is like this. Every year, government will check the financial statement of all companies. If government sees that most companies makes good profit, high profit, then the government maybe will charge more tax. And let's say if government sees that most businesses are making loss, then maybe government will reduce the tax rate, and maybe the government will provide subsidies to help businesses. Okay, so another example is lender. Lender is like banks and financial institution. They lend money. So our example is AAsia. AAsia every year publish financial statement. And let's say at one time AAsia need to borrow money from bank. let's say $50 million. So bank is the lender. When AirAsia apply to borrow money from bank, the bank or the lender will use the financial statement of AirAsia. Bank will check whether AirAsia has the ability to pay back the loan or not. If bank check the AirAsia financial statement and found that AirAsia has no sufficient cash to pay back the loan in the future, then the bank will not allow AirAsia to borrow money. So lenders, including banks and financial institutions, they are the user of financial statement, and they use financial statement to make lending decision to give loan or not to give loan. I think there are several more external users of financial statement. Okay, you can check them in the textbook. Textbook will explain several more external uses of financial statement. In the next chapters, in the next topic, I will show you the sample financial statement. Okay. Okay, now we see this financial accounting and management accounting. Okay, accounting is a big area. Accounting has several branches. Two main branches of accounting is the two main branches of the two main branches of accounting are financial accounting and management accounting. We have other types of accounting. For example, tax accounting, merger and acquisition accounting, forensic accounting. I think there are at least two more branch of accounting, but the focus in this in this course is only on two branches of accounting, financial accounting and management accounting. Accounting is these branches of accounting is like the thing is like this. You see engineering, there are several types of engineering. Mechanical engineering, electrical engineering, civil engineering, and there are many more. There is the same thing with accounting. Accounting has many types of accounting. The focus here is two types of accounting or two branches of accounting: financial accounting and management accounting. Okay, so see here, financial accounting is concerned with the recording and reporting of economics data and activities for a business. Like I said earlier, financial accounting is the type of accounting that you can use to record business transaction, and at the end of a period, for example at the end of the month or at the end of the year, you can use accounting to calculate profit or loss for the business. That is financial accounting. But management accounting is the type of accounting that will use both financial and estimated data to help manager to manage the business, to manage a business. Management accounting is a type of accounting that use financial data and maybe operational data. And the purpose of doing management accounting is to help manager to make business decision. You will learn about management accounting in topic 7, 8, 9, 10 and 11. Okay, this one I think there is a. Okay, so I hope I can explain several more things about the difference between financial accounting and management accounting. So first thing, financial accounting and management accounting. So there are several differences between financial accounting and management accounting. First is in term of user, in term of output. Okay, let's see in term of output. Financial accounting, the output of financial accounting is financial statement. Like I said earlier, every business, every companies, every year they have to prepare financial statement. In the financial statement, the documents in the components of the financial statement, there are 5 components: income statement, balance sheet, and 3 more. That is the output of financial accounting. Management accounting is the type of accounting that is used to help manager to make business decision. There are two main output of management accounting. First, cost report. Cost report shows data about cost of producing a product or cost of providing service. The second main output of management accounting is budget. There are many types of budget. Master budget, that is the most frequently used. Master budget. There are flexible budget, and also what else? Static budget. But most of the time, the most important one is the master budget. Okay, so in terms of output, the difference is like this. The output of financial accounting is financial statement, and then the output of management accounting are mainly 2 types. The first one is cost report, and the second one is budget. Okay, so that is the difference in terms of output. Okay, the second difference in terms of user. Who will use the output of financial accounting? Okay, financial accounting, the main user of financial accounting output is the external users. Remember I made an example. Let's say there is a company, Asia. Every year Asia will publish their financial statement. Who are the main user of this financial statement? The main user is the external users. External users like creditors, lenders, government, investors, they will use the financial statement for their own purpose. But for management accounting, the output is 2. The main output is 2. Cost report and budget. Who are the main user of this output? The main user of this output is internal users. Managers, they will use the budget, and also they will use the cost report to help them to do their work. Budget and cost report cannot be shown to external users. Budget and cost report are confidential data, should be used internally only. Okay, so that is the second difference. The first one is in terms of output. The second one is in terms of user. The third one I want to explain a bit is the third one is like this. Financial accounting is mandatory. It is required by law and regulation for a business to keep financial accounting report and to publish financial statement. If you have a company, it is compulsory for you to maintain accounting record and to publish financial statement at least once a year. That is what happened in Malaysia. And also, I think that is the same thing happened to China or other countries. They, a company like AirAsia, Alibaba, Amazon, what else? Tesla or anything. They are companies. They are required by law in their countries to keep financial accounting record and to publish financial statement every year, at least once a year. But management accounting, it is not required by law to keep and maintain management accounting record or activities. There is no rule or law required business to keep and to maintain and to record management accounting in their business. Companies use management accounting according to their needs. If they need to, they will use it. If the business needs to prepare budget and to calculate cost, then they will use management accounting. Otherwise, it is not compulsory for them. Okay, so remember that there are several more differences between financial accounting and management accounting. You can read them in the textbook. If I need to, I will explain about it later. Okay, I will stop at this point. This is part 1 of the lecture 2 for ACT for our group. Write your name and matric number in the comment section. I will take that as your lecture attendance. Thank you very much.